What's up, everybody? Thank you for being here. I wanted to give everybody an update because in my time being a real estate broker here in Southwest Florida, I have not experienced interest rates rise this quickly ever. The 30-year mortgage hit 5.25% as of yesterday. This is coming from Mortgage News Daily. I can link that for you guys below as well. That is the highest level since 2009, 5.25% on the 30-year fixed mortgage. Now, you can still get in a little bit lower on a 15-year mortgage fixed for a duration of 15 years at 4.42%. And then it was talking about the ARMs, adjustable rate mortgages, which I am pretty much against. I'm not a financial advisor in any sense, so don't take this as financial advice. But I'm against the adjustable rate mortgages unless you are a more savvy investor where you're gonna, for the short term, maybe buying and flipping property where you need maybe a teaser rate. But the 5/1 ARM is at 4.08%, which is lower, obviously, than 30-year fixed at 5.25%. But the 30-year fixed is the way to go, especially in the climate that we're at. You want to lock in a fixed rate, 30-year or 15-year. The ARMs, adjustable rate mortgages. So basically, on the 5/1 ARM, that thing is going to adjust every 5 years. So let's just play out the scenario. If it adjusts in 5 years and you paid $500,000 for the property, and let's say it did go down in value, and you owe 450 on the property, and it's worth 400, you guys are going to have to come to the table with a check at closing to either sell the property or do a refinance. What's up, Andy? So I think it's important that if you guys are getting a mortgage, that you just be aware of adjustable rate mortgages, because a lot of lenders are pushing these right now because a lot of people are fearful. They're not able to get into the 30-year fixed mortgage now is 5.25%. That's significantly higher. Several months back, we were at 3%. So you're talking hundreds and hundreds and hundreds of dollars more per month, and that just reduces your purchasing power as a buyer in the real estate market. So be aware that this is, based on their analysis, the biggest, fastest jump since 1994. Obviously, the Fed is doing what they're doing to increase short-term rates, and that's having an effect on mortgages interest rates. Obviously, the Fed needs to really take control of inflation, and they really need to pay attention to the employment range and keeping the employment range in order as well. So that's why the Fed is doing what they're doing. And the Fed only went up 25 basis points. They're talking another 50 basis points here pretty soon. And I think 6 or 7 more rate hikes. It looks like by the end of the year, they'll be at 2.5% with the Fed rate. But who knows? Anything can change. I wouldn't say the Fed's that reliable in terms of what they say. But obviously, it's having an effect on short-term money as well. I recommend, if you guys have credit card debt or any kind of short-term adjustable debt, do whatever you can to get out of it. Stop stacking up credit card debt, because it's only going to get worse. I think that those rates are only going to get higher, and it's going to cost you a lot in terms of interest on credit card debt. If you guys have questions too, drop them, and I'll try to get to you by the end of this live feed. When the Fed was at 0%, they were buying over $100 billion in bonds each month. That's another thing that is contributing. They're actually quantitative or tightening now, which that's what they say they're doing. Who knows? But basically, they plan on reducing the amount of bonds on their balance sheet. So I think some of these, when they come due, they're basically not going to just buy new bonds. They're just going to let those expire out, take the funds, put them back onto their balance sheet. But you got basically 9 trillion of stock of bonds, and they're talking about cutting holdings by 95 billion a month. which is significant. I think that they were buying about 100 billion a month in bonds, and that included, I think, 40 billion of mortgage-backed securities, which, when they're buying, they're the major player buying mortgage-backed securities, and when they're slowing that down and slowing down that purchase, loans are going to be mortgages are going to be more risky. So lenders are going to want more calculated risk benefits. So they're going to charge, if you want a lower rate, they're going to charge you points. And obviously they want a larger spread. This is why another reason why the mortgage rates are going up. Let's just take an example though, in terms of how this affects you. If you guys are in the market to purchase real estate, you got, based on a $400,000 property. Now, this is just principal and interest. It has nothing to do with insurance or taxes or maintenance of the property, but just principal and interest. If you bought a $400,000 property at 3%, your payment would have been just over $2,000, so $2,029 a month. At 5.25%, where we're at right now today in today's market, that's a payment, principal and interest payment of $2,552 per month. That's a difference of $523. So again, not even a year ago, you could have locked in 3%. Actually, you could have locked in under 3%, maybe 2.75%, and you'd be paying over $500 less than you are today. So again, Americans' purchasing power for real estate is getting less and less. Now let's amp it up, because I think that, and you guys let me know in the comments below, I think that mortgage interest rates will continue to rise for the short term. I think long term, it's going to be good for long-term rates, where they're going to settle out, maybe come back down. I think for the short term, we're going to see mortgage interest rates rise. And I think it could potentially be as high as 7% this year. Again, this is my opinion, for whatever that means. I'm not a financial advisor in any sense, so take it for what it's worth. But let's say that same house for $400,000, you picked up at 7% interest. Your principal and interest on that would be $3,000 a month. So compare that 7% interest loan compared to the 3% interest loan. That's $1,000 per month on that same house. Same house, same price. Just your interest is, your payment is $1,000 more. Compare the 7%, compare that to 5.25, where we're at today, which is something to think about, because, if rates do go up to 7, you might be thinking like, damn, I should have jumped into the 5.25%. But based on that analysis, you're paying $452 more per month on a 7% loan than a 5.25% loan. I think my biggest advice to you, I did other videos on this channel too, if you guys are in the process of buying, there's that video. It was an unbiased video. I just went through that several questions that I think you as a family should talk about and consider before making a purchase, because everybody's situation is different. Whether you're buying or selling real estate, nobody on YouTube or anywhere else should be like, you should be selling your property or you should be buying right now. It all depends on personal circumstances, personal situations. So, I think that you go through that video if you guys are buying. But, if I got to give you any advice in today's market, if you guys are buying, be sure you live within your means. I think a lot of people get approved for a $500,000 property max, and they go out shopping for, in fact, a $500,000 property. And, being house poor is not fun. When you're house poor, all your money, a lot of your money is going to just pay for your house. And there's other unforeseen things that happen in a house. You have a HVAC that might go out. You might have a roof leak. You might have issues with the house. And, that could be costly for you guys. So you got to take that into consideration. Also, you got to take into consideration rising insurance rates. In the state of Florida, our insurance rates are just skyrocketing. There's been a lot of kind of scandalous bullshit going on, where you have attorneys teaming up with roofing contractors, and they're basically suing the insurance companies to get people free roofs. And that really has driven and skyrocketed insurance rates in the state of Florida. Now you might not be in Florida, but you might be in an area where you have other natural disasters. You might have hurricanes or tornadoes. You might have wildfires, whatever it is. But I think you know insurance rates are going to continue to rise. Also, when you're buying real estate, remember that a lot of times the tax bill that you're looking at in MLS or wherever you're looking at, that tax bill is for that previous owner, and usually they're going to adjust that tax rate to coincide with the current market of what you paid for the property. So be sure that you guys take that in consideration as well when you guys are actually buying a property and figuring out your analysis. If you have a good mortgage broker or direct lender, it's probably ideal to sit with them and talk about what that actual tax bill is going to look like. A lot of property appraiser sites too, they'll actually have a tax bill calculator that you guys can figure out what it will be on the new assessed value. So I think that's important. A lot of people don't take that in consideration. Excuse me. And why am I saying a lot of this? Because I think there's a lot of people that they're in the real estate market. They're looking to buy real estate, and I love real estate. I do. I'm very passionate about it, and buying it, selling it, holding it, renting it. But I think it's all about buying right. And if it is your home where you're living, prepare for the worst. Make sure you guys have a reserve account lined up. Make sure that you guys are in good financial position before you take on the responsibility. Remember, people look at we're in like a payment society. They go buy a new freaking car and they're like, oh shit, it's $400 a month. I can afford that. But they just signed away on a 7-year freaking term for a $50,000 prop or car, or whatever the case is. The point I'm making is, look at how much debt you're taking. Taking hundreds of thousands or millions of dollars worth of debt where you live, it's a big deal. And I think that people just need to be cautious and live below their means. And if you live below your means, you're going to be much better off in the future, because you can take additional money, you can put it aside, and you can invest in income producing assets. I think a lot of wealth is created through real estate, but what a lot of people don't understand is it's usually not the home that you live in, which is creating a better, wealthier position for you. A lot of people, they're like, and I see it in the comments and everything else, like, man, I got like $200,000 of equity in your home, but that's not realized. It's not a realized gain because you're not selling it. That's the place where you live. So that money is stuck there, and that equity position could be depleted if our market goes down as well. So, where the wealthy get wealthy in real estate is income producing real estate, and getting those properties, fixing them up, adding value, getting rent rates up, and then selling them, doing 1031 exchanges into other properties. So, the real wealth in real estate is not the home that you live in. A lot of Next Door Millionaires, good book, by the way, The Millionaire Next Door, they did a mass study on these guys and girls, and they found out, they live in modest homes. Their homes that they live in on average are worth like $250,000. They live in, not glamorous neighborhoods or anything like that. And all their other money they just have into investments. So, if I could give any advice there, it's just to invest in assets and not liabilities. And yeah, Logan, it is a great book, man. No matter how you twist it, your house where you live is a liability, because unless you're house hacking, unless you are renting out rooms, and I've done videos on this too, and that could be one of the first houses I bought. I lived in one bedroom and I rented the other bedrooms out to college buddies. So unless you're house hacking and making money, the property you live in is in fact a liability, because it's taking money out of your pocket every month. So the more money that you can keep in your pocket, the more money that you guys can invest in. see if I got any. Think supply and demand will go through a phase where both are destroyed. I think housing transactions overall fall off a cliff before we may see major price decreases. I just finished up a video today on price decreases. We're starting to see them in Southwest Florida, and I showed the back end analytics on our MLS. It's not hugely significant, but it's there. It's happening. So we are starting to see price decreases for sure. Mr. Kilroy seeing price drops now on homes. Yep, exactly. I don't know where you're at. If you're still on, let me know where you're at. Curious. My Springfield sniper, my wife and I did a cash out refi to redo the kitchen last year and got a 2.5 rate, 450 value, 60% LTV, 18 cash out. The same loan right now is 4.875. Yep. The problem, it looks like you're in good position. The problem with the cash out refis is we've seen a lot of that happen over the last couple of years. Is people were not just refinancing into a low, taking advantage of the low rates. They were doing cash out refis, and that really doesn't put you in a better position. Like, with this guy, I'm all about, like, if I fix the property up, now what kind of equity do I have and can we flip it? And I'm doing that right now with this condo that I'm in right now. I love this condo, but we're flipping it. We're actually set to close in about 10 days from now. So, if I'm going to do a cash out refi, it's going to be because I'm making financial moves and not for the reason of financing an improvement for my own. If anything, I'm going to save up money and pay cash for it. Yeah, you look to be in good shape for sure. And it wasn't a big cash out. You said $18,000 cash out. That's not. But I'm seeing. I mean, it's ridiculous. We're seeing people. They were in a low loan. Their debt position. They owed, call it $200,000, and now their property's worth, because they paid down the debt and everything else over time, and it's worth, $450, and they're cashing out hundreds of thousands of dollars just to put in their pocket. I don't know if they're reinvesting it, but I think a lot of people are paying off credit card debt and other consumer debt. And unfortunately, those people went from, maybe they had 18 years left on that mortgage or whatever it was, and now they're back into a 30-year term. I'm of the mindset and position of I want to pay my mortgage off. And when you and I've done another video on this too, the benefits of being free and clear on the home that you live in. And if you guys can accomplish that, I mean, a lot of people think that's bad advice. And again, I'm not a financial advisor, but people think, oh, that's the wrong move. For me, it's not, because when I became free and clear where I live, my whole mindset shifted. You don't have that burden. You don't have that stress. You don't have, even if, like, let's say I had a chunk of money and I could pay my house off, but then instead of doing that, I took that chunk of money, I bought an investment property. I still, in my mind, and thinking that property, I got to worry about the tenant. I got to worry about the tenant paying me. If they don't pay me, I got to go through eviction. If they do something to it, God forbid it burnt down, and then I don't have an asset, that cash flow asset that I got to rebuild. So I look at it more like it's just complete peace of mind with it being free and clear, as opposed to a lot of people who are just doing crazy amounts of cash out refis. Yeah. He's asking where's everybody getting all this money? I think a lot of people are pulling cash out of their houses. And a lot of people I know are pulling. I mean, I'm a real estate broker in Southwest Florida, and we have sold homes to people that were paying cash for the properties here, but they were doing a cash out refi on a house up north or whatever the case is. Now, in some cases, it was a good move because they could use the property here, they'll rent it out, whatever the case is. Good move for them. Again, I'm of the mindset of my homestead. I want to be free and clear, just because, I don't have a stressful life when it comes to finances. And I've been able to grow my wealth a lot quicker because, not paying, 2,000, 3,000, $5,000 a month in a mortgage, it stacks up pretty quickly. So as long as you're smart with the money. Um, yeah. So one other thing I was going to address. Another thing, I got a video coming out this week. I got to finish up the edit. I got to hire a damn editor. You guys know anybody that's good at editing that can help me out? Let me know. But it's the amount of people having 75% of buyers have buyer's remorse. It's astonishing. Got that video hitting probably tomorrow or the next day. But it was a study done, and the big takeaways, if you guys are buying real estate, there's still a frenzy in a lot of markets, and people are emotional about buying real estate, and they have blinders on. They're seeing all the other people at the open house, or they hear that the house has 30 offers on it, and they're overpaying and everything else. But I think it's really important that three main things: don't overpay. The next thing is be sure you can't change the location of real estate. So make sure that that location is where you want to be. Part of that article is people that were buying, they went further away from where they live and from where they work and live. So their commute to work was a lot longer, and that becomes draining, especially with gas prices going up. And also think about this. Let's say before you're renting a house and it took you 5 minutes to get to work, and now you bought a house and it's 30 minutes. That's an additional 50 minutes of being on the road, going there and back total, that you're not spending with your family and friends and everything else. So I think that that's important outside of just the financial aspect of it. And then the other thing is the structure. A lot of people are buying houses that just were too small for them. We're talking to some people right now, and unfortunately they were talking about a smaller house, and I was like, if you're a growing family and everything else and working from home, unfortunately you got wants and you got needs when you're buying real estate. And I think your layout needs to be part of your needs section, and your wants needs to, maybe not go with that pool, or make some other adjustments for your needs and your wants. And then another video we got, actually, I think hits tonight. It's qualifying for mortgages. I did a video on that. I think that mortgages are going to be more and more difficult to qualify for based on the article that I went over in that video. So you guys probably want to check that out as well. And I got to roll, guys. I appreciate everybody being on this. And if you're not a subscriber and you want more information about the housing market, then be sure to subscribe. And I got, I'm trying to do 4 to 5 videos a week based on things that I find interesting and things that I find would provide value to you guys. If, I don't hit those numbers, it's because I'm not finding as much anything of value. But I wanted to get this video out because damn, rates just jumped up 5.25% on the 30-year fixed mortgage. That's big. That's high. And again, that's the highest level since 2009 and the biggest, fastest jump since 1994. As always, thanks for being here, guys. And check out some of the other videos we got coming up. See you guys.